I'm Joe Massey with Castle and Cooke Mortgage, and I have been a part of the Your Castle First Alliance Castle and Cooke team for, 13 years now that I've worked with Jared and Lon and Greg and Eric Romero over at Your Castle and First Alliance. And today we're going to be talking about how many properties do you need to retire. But before we get started on that, let me introduce my co-host, Mr. Jared Patterson. Who are you?
Hey, thanks, Joe. Hey guys, I'm Jared Patterson. I'm one of the relationship managers at First Alliance Title. I've been in this real estate world for 30 years, 25 on the agent side, so I was one of you, and then I've been on the title side for the last 5 years. So my job is to be a resource and to help you grow your business and show you ways to grow your business. So I love sitting down and analyzing what you're doing on a weekly, daily, monthly basis to achieve your goals in real estate. And so let me be part of that journey.
Outstanding. If you have not had an opportunity to work with Jared, I would highly encourage you to do so. I've worked with Jared for a decade now, and they do just a phenomenal job over at First Alliance on title, on questions, on settlement, just about anything you might need over there. So I'm going to go ahead and share my screen. And so what we're talking about today, how many properties do you need to retire? And the number one answer to that is probably fewer than you think. So a lot of people think I need a portfolio of 10 or 100 or 200 or 300 properties to retire, and nothing could be further from the truth. And that's what we're going to be talking about today. So if you want to earn a passive income of $72,000 a year. Now, how did I come up with $72,000 a year? What we thought about on that is we said, hey, what would it be if I wanted to make $6,000 a month? So $72,000 is kind of the average income that many people have prior to retirement. And if you wanted to continue to have that $72,000 a year through retirement, or $6,000 a month, what would you need to have in real estate in order to accomplish that goal and keep your income the same at $72,000? Now, an important exercise for you, maybe you make more than that. Maybe you make $100,000, so you want to have $100,000 a year. Or maybe you make less than that and you only want $50,000 a year. We're not here to tell you everybody should be targeting $72,000 a year or $6,000 a month. Just kind of an arbitrary number that we picked because we see it's kind of an average that a lot of people make prior to retirement. So if you want to earn that passive income, here's what you would need to do. You would need 3 homes that are worth $400,000 completely paid off, all right, which would be the equivalent of $1.2 million worth of house or houses. Or if you'd like to invest in condos, you would need 5 condos at a value of $250,000 each, or $1.25 million worth of condos. Or maybe you'd like to invest in multi-units. You would need 2 $700,000 triplexes, or $1.4 million worth of triplexes. And you might be thinking to yourself, well, okay, that's great, but I don't want to just stroke a check for $1.2 million or 1.25 or 1.4. And so we're going to talk about that today. How can you get to this and have somebody else pay these properties off for you? And the trick is starting today or soon, and then holding these properties over a long period of time. And that's how you can get to this, 1.2, 1.25, $1.4 million without having to just write a check for greater than $1 million. And what this equates to is at a 6% cap rate, which is pretty reasonable. Maybe tough to find that in today's market, but over the long term, a 6% cap rate is a pretty reasonable return. If you have that $1.2 million in real estate, $72,000 a year on single family residences. Or if you've got that $1.25 million in condos at a slightly lower cap rate, because it's often impacted by HOA dues, to get that same $72,000, you would need a 5.75 cap rate if you're buying condos. Or multi-units, that 1.4 million times an often lower cap rate on multi-units is going to get you that same $72,000. Now, Zoom keeps giving me a bunch of messages, but there we go. All right. So continuing on, if you want to retire today with $72,000 in passive income, very simple. Stroke a check for $1.2 million to buy 4 single-family homes, or stroke a check for $1.25 million to buy 5 condos, or stroke a check for 1.4 to buy 2 triplexes. But Jared, let me ask you, how many people, and you talk to a lot of people, just like I do, how many people do you know that are ready to just write a million, 1.2, $1.4 million check so that they can retire? Is there a lot of those people out there?
That's called the big old needle in the haystack.
Yeah, there's not a lot of those. But what are some other what are some other ways you might be able to accomplish this? What if you don't have 1.2 to 1.4 million dollars? What if you could invest $300,000 today and retire in 15 years? So this is an important point, is understanding that time frame and the power of leverage and compounding over a long period of time. So I want you to think about, how does this fit with your current cash position and your time horizon? So you might be sitting there thinking, well, I don't have 1.4, I don't have 1.2, but I also don't have 300,000. Well, that's okay. How much do you have? Or if you're a real estate agent and you're working with clients, how much do your clients have? And what is your time horizon? Maybe I want to retire in 20 years or 30 years. So maybe I could start with a lower dollar amount if I have a longer period of time. And so you also want to ask yourself, do you want more than $72,000 in income? Do you have more or less time before retirement? Or do you have more or less money that you're starting with right now? And so a lot of these are variables that you want to think about. But again, we're going to go through this basic example of saying, hey, I want to get to $72,000 in 15 years, starting with $300,000. So regardless of where you're starting, these are the arbitrary points that we picked, again, based on what we see commonly. But again, your position is likely different than just what we've picked out here. So let's look at a sample townhouse. And an important point is everything we're going to show you today are real properties. So this is a real transaction that I did the loan on and Jared did the title insurance. So list price on this property was $270,000. It's in Denver over in the Cherry Creek townhomes. It's an attached single family home, and it is a 4-bed, 2-bath home, roughly just under 1,600 square feet. So let's analyze this property just as a single property that we might be interested in. So the number one thing you want to understand is, how much does it take to buy this property? So this is a single 1-unit property that cost $270,000. And the investor put 30% down, 25% down. Closing costs was roughly $3,540, and repair costs were roughly $1,000. Now you might be thinking, yeah, Joe, but closing costs are higher than that. Well, here's one of the great things you can do when you buy an investment property is you can get the seller to pay up to 2% of the contract price towards your closing costs. And that was something that this particular buyer did, is they had the seller pay 2% of the contract price towards their closing costs. So the net closing cost that this buyer spent was that $3,540. Now this property was nearly turnkey. Anything with repair costs of less than $5,000, I would describe as turnkey. So $1,000, that was like cleaning the carpets, fixing a couple of window screens, maybe, servicing the furnace. So walking out of First Alliance Title, they've got the keys, they've started down their road to owning property, and they've invested $72,000. Now let's go through the annual cash flow statement. Let me clean up some of my notes here. So annual rental on this, $24,600. Now that's the annual rent. All right, so on a monthly basis, it's $2,050 per month. And you always want to have some expected vacancy. Jared, what's vacancy in the Denver metro area right now? Do you know? Is it less than 4?
Yeah, it's somewhere between 2 and 3 right now.
Yeah, so I always like to factor in at least 3, sometimes 4 or 5% vacancy.
I like 5.
And this
personally.
is the period. You like 5? Yeah. This is the period
yeah.
throughout the year that the property is not going to be occupied. Okay. So at some point during the year, the tenant is going to move out and you're not going to be getting rent. Now you want to factor in reserves. All right. I like to factor in for a condo 5% of the monthly income for reserves. HOA dues on this property were just under $300 a month. Property taxes, roughly $1,200 a year. Property insurance, about $210. And everybody might say, well, that's really low insurance. It is, because the exterior of the building, the roof, the sidewalks, the deck, the exterior, outside part of the property, the neighboring walls, etc., that's all covered by the HOA insurance. So all you're having to cover for your insurance is what's called an HO6 policy, which is the interior of the unit. So total annual expenses, roughly $6,100. This gives us a net operating income of $17,756. Now, of course, they have to make a mortgage payment. That's the biggest expense. So on an annual basis, that's just under $12,000 a year. So annual cash flow in this property, $6,155. So this is a cash on cash return of 8.5%, meaning they're getting $6,100 a year. They invested $72,000 to buy the property. That's an 8.5% cash on cash return. The cap rate is this net operating income over here divided into that total purchase price of $270,000. That's a 6.6% cap rate. And then one of my favorite metrics, the gross rent multiplier. This is just simply taking the purchase price divided by the monthly rents, and the lower this number, the better. So 132 GRM is good. I would say, above average, and the lower that number, the better. Now let's look at other ways that you're getting return on this property. So we have our return on investment quadrant. So the first way is you are getting cash flow. That's $6,155. The second way you're getting a return on this property is through depreciation. So you can depreciate single family residences or condos or townhomes over 27.5 years. Now, I don't know why the IRS picked 27.5 years. That's a very strange non-round number, but you can depreciate this property over 27.5 years. And based on your tax bracket, your actual cash return on that depreciation is $2,671. So that's a return that you're getting from owning this property. Now you're also getting debt reduction of $3,566. Now, Jared, let me ask you, why is debt reduction considered a return? Because anytime we take out a mortgage, every month we pay a portion towards principal and we pay a portion towards interest. In this first year, we've paid $3,566 towards principal, but why is that a return? Tell me about that.
It's equity, baby. Yeah,
that's right. And who's paying
you're
it?
Earning other people, OPM.
That's right.
You're
That's exactly right. The tenant is paying that, right? So that reduction in principal, the tenant is paying that. And appreciation. So right now, properties in Denver appreciate anywhere from 3, 5, 7%, depending on the area that you're in. We assumed 5% appreciation on this $270,000 purchase price, which is $13,500. That is the fourth quadrant that you're getting a return on. So in all four of these quadrants, you're getting a return of $25,891. Now, on a percentage basis, you only invested, remember, $72,000, and you're getting that 8.5% cash on cash return. You're getting a 3.7% depreciation cash return. You're getting a 5% debt reduction from your tenant, and you're getting an 18% return on your investment from the appreciation. This is a 35.9% return on your investment of $72,000. Now, Jared, let me ask you, 35.9%, is that a good return?
Amazing. Incredible.
Yeah, that's an incredible return. I'm sure you get that in your 401k, your IRA. I'm sure this is common that you see in the stock market or other, CDs or savings accounts. Is that right?
Yeah, we wish.
Yeah, not a chance, right?
Nope.
So it's important to understand real estate is one of the only ways that you're going to get returns in each of these four areas, all right? And we've got a $270,000 asset, but we only invested $72,000. Now, $72,000 is still a big number. I understand that, but it's a heck of a lot less than 1.2, 1.25, or even $1.4 million. So let's pause for a minute there. Any questions? Did I explain this well? Or Jared, anything you want to add to this analysis?
No, it's a great opening property to buy.
Yeah, pretty
Solid
straightforward,
return.
right?
Yeah, exactly.
Guess where the investor found this property?
You and I both know the MLS.
It's on the MLS. That's right. So these are actually out there. I see deals very similar to this right now. You may have to make a little bit more of a down payment depending on the price, depending on the interest rate that you qualify for. Maybe you don't get as much cash flow, but you're still getting debt reduction, appreciation, and depreciation. This example is a real property that closed within the last 12 months. And it's important to understand these are out there and they're on the MLS, and we are seeing more of them as inventory is continuing to increase. So don't forget, these are out there. Agents on the call. This is a great type of property that you could find for your investor clients. So now let's move forward and see what do we have to do if we want to retire. So let's talk about scenario number one. And this cash flow statement here is exactly this cash flow statement here. So I've just kind of cleaned it up and moved it over here where it's a little bit easier to read. So in our first scenario, we're going to make the minimum monthly payments and all of the cash flow that comes in from this property, which is $6,155. We're going to put that money into the bank and we're going to keep that $500 a month. All right. So this is the same cash flow statement. And at the end of the year, the value of this property has gone up by that $13,500 and the mortgage balance has gone down by that $3,300. We now have total equity of $84,566. Now let's just wait 15 years and let's see what happens, right? So we have a great spreadsheet. If you guys haven't seen, you can get it from our website. It's loansbyjmassey.com. And this spreadsheet, you plug in this information on your property and it will do an entire forward-looking projection for the next 30 years. So what happens in 15 years? Well, Jared, what direction do rents go?
Up.
That's right. Rents go up. All right. What direction do reserves go?
Oh, up. Yeah, absolutely.
Yep. HOA dues, taxes, insurance. What direction do all of the expenses go?
Only go up.
They only go up. One expense doesn't go up, and that is the mortgage. It is the only inflation protected piece of this entire puzzle. And so it's a really important piece that rents go up, but so do the other expenses based on inflation. But the mortgage is inflation protected. It does not change. So guess what? In 15 years, this property is now generating you $15,000 per year. And the value of the property has doubled to $561,000. And that mortgage has paid down to $130,000. So now you've got $430,000 in equity in this property. Is that pretty cool, Jared? What do you think?
Yeah, I love it.
Yeah, I agree. Now, if you want to have that $72,000 of income in 15 years using this sample property, in 15 years, it's generating you $15,000 a year. So you need to have 4.7 properties. You can't really buy 0.7 of a property. So you round that up. If you were to buy 5 of these today and wait 15 years, you would generate that $72,000 of rental income. But take a look at this. What happens to the value? You have 5 properties that have more than doubled in value. So you've got $561,000 per property times 5. That is $2.8 million of value that you have in real estate. But the cool thing, your initial investment of $72,000 times 5 properties, that's an initial investment of $360,000. But Jared, what if I don't have $360,000? What if I only have $72,000, but I can save and maybe have another $72,000 next year or 2 years from now or 3 years from now? If I don't have $360,000 right now, what should I do?
Just keep putting the money in the bank, and when you have enough money to start that next property, either you can gain it in a couple different ways. One, just through accumulation of your savings, or as values of your properties go up, then you can use some bridge loans and things like that to get value from there to go to different properties. It's really just a matter of mixing all these different avenues.
Exactly right. So maybe I buy one property today, maybe I buy another property in a year, Maybe I buy 2 properties the year after that, and maybe 1 more property a year after that. So maybe I don't spend $360,000 today. Maybe I spend $72,000 a year for the next 4 or 5 years. And then instead of it being 15 years, maybe it's 20 years when I have my full portfolio. But I don't have to invest all this money today. I just have to invest or choose to invest what's available to me today to line up with my long-term plan. The cap rate on this is actually worse than we looked at our initial scenario. All right, based on $131,000 of net operating income, which is $26,000 times 5, divided into this value, that's a 4.7 cap rate. So what we see is the reason that cap rate has gone down is because values go up faster than rents. So let me ask you, Jared, if I could invest $72,000 today over the next 5 years, is that an easier pill to swallow than writing a check for $1.2 or $1.4 million today?
Absolutely. Yeah. Rome wasn't built in a day.
I completely agree.
Take it one day at a time.
That's exactly right. That's exactly right. Now let me pause. Any questions on this? Is this making sense for everybody that's on the call? All right. You guys are a lively bunch. No problem. Okay. So now what about this? What if you say, yeah, Joe, this is great, but I don't need this cash flow. I have a full-time job and I don't need this $6,000 a year. Can I get a better return? Well, let's look at that. What if we take all of the cash flows and pay down the mortgage? All right. So we got the same property, the same annual cash flow statement, but right here at the end of the year where we have $6,000 in cash flow, we're going to take that and apply that back towards the mortgage balance. This builds our equity faster and will help us get out of debt faster. So what happens after 15 years? Rents have gone up, expenses have gone up, but there's no mortgage payment. Jared, why is there no mortgage payment?
Because you were so diligent and paid it off.
That's exactly right. We were very disciplined and we took that cash flow every single year, and now that mortgage is at a 0 balance. So now we've got $561,000 in value minus our mortgage balance. We have a full 100% paid off property generating us $26,858 per year. Now, if we want that same $72,000, we only need now 2.7 properties. You can't really have 0.7 of a property. So we've got to buy 3 properties times that $561,000 will give us $1.6 million of real estate by investing $72,000 over 3 properties over the next 3 years. This is only a $216,000 investment. Is that a good deal, Jared?
Absolutely.
Yeah,
Love it.
I completely agree. And at that same 4.7 cap rate, we're generating $79,144, right? And it's a little more than our $72,000 target because we rounded up to 3 properties. So the last thing you might say is, well, yeah, Joe, but that's great. I still want to buy 5 properties and apply all of that cash flow towards the debt. What would that look like? So scenario number 3, we're going to use the same $360,000 that we had in scenario number 1. And instead of only buying 3 properties and paying them off, we're going to buy 5 properties and pay them off. So 5 properties times that $561,000 value, $2.8 million of real estate in 15 years at that 4.7 cap rate. That is income of $131,000, or with it rounded up to 5 properties, $134,290. So Jared, that's nearly double scenario number 1, but the same investment. Would you prefer scenario number 1, where you are not paying down the mortgages, or would you prefer scenario number 3, where you are using the cash flow to pay down the mortgages? Which do you like better?
I really think it depends upon where you are in your life. You know, I think they all have their you know, if you're really just starting out, then I probably would do the earlier session. If you're doing later, then I'm going to try and work a little harder and get it paid off.
I think you're exactly right, and that's exactly the right answer, is it really just depends, right? So neither Jared nor I are going to tell you you should do it absolutely this way or you should do it absolutely this way. The whole point of this is showing you here's routes that you can achieve this, here's routes that you can share this with your client and have that conversation and let the client figure out which one is the right route for them. Or if you're the client, which one is the right route for you. Now, I want to talk about some concerns that I hear from investors. So Jared, let me ask you, do you hear clients say these properties aren't available anymore? Do you hear that ever?
Every day.
Every single day. And I agree.
Yep.
These properties are not available except for all the ones that I see every single day. And we go back to 2014. This was a great quote from my buddy Travis Spear. And think about this. This was 10 years ago. And guess what we were hearing in 2014? Oh, there's no properties available now. Oh, there's no way to find any good deals. Well, his quote, which I loved, if you think there are deals or you think there aren't any deals, either way, you're right. And this is somebody who has invested millions of dollars into real estate over the past 10 years and has done exceptionally well when so many other people were out there saying there's no deals. So my point on that, there are plenty of these available on the MLS. And remember, this is not a home run grand slam deal that we're looking at. All right. What we looked at is just a basic single or double. A 5% or 6% cap rate will do just fine to put you on this path over a 15-year time horizon. Now, another one I hear, what if values go down? Do you hear people talk about this right now, Jared?
Yeah. Who cares?
Yeah, exactly. It is only a concern if you need to sell while values are down. If you're buying for long-term investment property ownership, there has never been a 10-year period in Denver that you would have lost money. But people have this concern, and this is a really important one you want to share with your clients. Let's say you buy the property loses 50% of its value the day after you buy it, and it never ever goes back up. What happens? And I think this is going to blow you guys away. So we buy the property, we start renting it out, and the day after we buy it, the value goes down by 50%, and we are upside down $57,000 on that property. Now, as long as we don't sell it and we just keep investing that cash flow back into the property, what happens in 15 years? The value doesn't go back up by a single nickel. It's still worth only $135,000, but what do you know? It still cash flows the exact same because cash flow and rents are not impacted by the value of the property if property values go down. So now we've got 5 properties generating that exact same $26,000, $134,000 in cash flow. It's the exact same cash flow. And 5 properties times $135,000 value. The portfolio value is now only $675,000. But how much did we invest? $360,000. So our return on investment of $360,000 with a $675,000 return, that's an 87% return over 15 years. So Jared, let me ask you, do you know any other investment that could lose 50% of its value the day after you buy it, yet you would still get $134,000 in 15 years and you would get an 87% return over 15 years?
No.
Exactly.
Nope.
All right.
And Joe, you and I both know the only thing that never goes down is rents. I mean, for the most part, obviously there are exceptions, but for the most part, rents never go down. So they're always going to increase.
That's exactly right. So this is an important one for agents on the call. If you have clients that are concerned about values going down, share this with them. If values go down, who cares? That was Jared's first reaction. What happens if values go down? Who cares? Doesn't matter, right? You can still rent the property. You can still pay off the mortgage. And if values never, ever recover, which first off has never happened, but even if it did, you get an 87% growth on your investment and you get the exact same cash flow in 15 years. Now, another one I hear, what if the property gets damaged? What if it needs repairs? Well, this is already built into the analysis because we've got a 5% reserve for repairs and maintenance. So we've already factored in $100 a month for repairs to this property, which you'll notice goes up as rents go up. So in 15 years, you're actually factoring in $150 a month. So that's already factored in. But depending on the age of the property, the condition, if you've done renovations, you might decide to reserve a higher or lower amount. So what I often see is for single family residents, multi-units, you generally want to reserve about 8% per month. Condos, maybe 5% per month. Older homes or something that's not recently renovated, you might want to reserve as much as 10% per month. And you just build that in, that's one of the expenses that I'm going to have every single month or every single year. Now, one of my other favorites, I don't want to find tenants. I don't want to fix toilets. I don't want to manage the property, especially in a competitive or especially in a difficult regulatory environment like we have right now. You might want to hire a property manager. I have a property manager. I don't do anything. I buy properties, hand them the keys, and I get a direct deposit on the 15th of the month. All right. So if you're like me, great. Hire a property manager. But they're going to charge you something. That's exactly right. Nobody works for free. So the industry average for property managers is 10% of your monthly rents. Well, what does that do? On our cash flow statement, now we have $2,460. So 10% of the annual rents are being taken by the property manager. So now this property only generates $3,695 a year. Is that the end of the world, Jared?
No. For peace of mind,
really
absolutely not.
That's exactly right. That's exactly right. So to get to having this property paid off does take a little bit longer. Now we're talking about 18 years. So in 18 years, this property is fully paid off with no mortgage balance, and it's generating $25,000 per year. So we still accomplished our goals. It just took us 3 years longer to pay off each property, but how much less headache did you have? And that's what I think of my property managers. They're like a gigantic Advil, right? Every month they send me an Advil and they send me a direct deposit and I have zero headaches. All right. So you might say, well, I really want to retire sooner. Cool. You're going to have the headaches of property management for 15 years, or I don't want any headaches. I'm cool to retire in 18 years. All right. So I think that's what you really need to think about is property managers are absorbing the headaches for you. They're just like a giant Advil, and I love my property managers. If you ever need a referral, let me know. They're excellent people, and I have 0.0 headaches. What's your take on property managers, Jared? Do you have one?
Oh, absolutely. Yeah, I've had the same person for 12 years now back in Pennsylvania on my properties, and they're amazing.
Yeah, they're excellent. They are excellent. All right. So very last thing I want to point out is we did a comparison of what if I had $100,000 and I wanted to invest that into various different asset classes. So the very first thing we looked at is if I were to buy an annuity, and that I just put $100,000 into an annuity and it just pays me a check every single month for the next 30 years. This is going to return me about $110,000. Or what if I took that $100,000 and I put it into the bond market and just had it reinvested every single year or every single month? In 30 years, it's going to be worth about $800,000. Or what if I just pay $100,000 in cash for one property and I get rents and that property goes up? What happens in 30 years? I will have gotten a return of about $1.02 million. Or one of my favorites, people say, hey, if I had $100,000, I would just buy gold. Okay. We took the average return of gold over the last 30 years and said if we put in $100,000 today and got that same average return over the next 30 years, what would happen? And you'd have about $1.3 million. Or what if you took $100,000 and you put it into the S&P 500 and reinvested all of those dividends? What would you have in 30 years? You would have about $2.6 million. Or what if I took that $100,000, divided it into 4 properties that I put $25,000 down on each property? Again, these are small properties, let's say $100,000 each. What would happen? In 30 years, I would have gotten cash flow, depreciation, debt reduction, and appreciation, and would have returned me roughly $3.7 million. Which one do you like best, Jared?
I'm all about the the higher return on investment. So properties are my game.
I agree. For everybody listening, does that mean you should take all of your money and put it into leveraged real estate? What do you think, Jared?
No, absolutely not. No,
That's right.
yeah,
Yeah. For
gotta
full
have liquid assets.
transparency, I have money in every single one of these asset classes. Some do better, some do worse. Anybody that tells you the only way you're going to make money is this is probably selling you something. All right. And Jared and I are not here to sell you anything. We're here to offer education. And I think you should look at all of these and probably have money into all of these different types of investments. And over time, your $100,000 is going to end up, somewhere here, because you're going to have some things that are a little worse, some things that are a little better, etc. But you're going to make money and be diversified and get a really good return on that $100,000 if you invest it across various asset classes. So I think that's really important to understand. Anybody that tells you you should only do this or you should only do this, just be wary of that. And that's the whole point of this presentation. This is one route that you can use in your portfolio for retirement, but it's not the only one. Look at all of these different things. So as we're wrapping up here, if you have any final questions, put them in the chat. But Jared, tell us a little bit about yourself. Who are you? Why should we call you? And how can you help us?
Yeah, guys, like I said, I'm here to be a resource. I love helping agents grow their business. We produce marketing materials for you to stay in touch with your sphere of influence. We also have a great app that has pre-done materials on it that you can send out to your social media, and which is what this business is all about. It's staying in touch with your sphere of influence through social media, through phone calls, through coffee, happy hours, things like that. So let me help you figure out ways to grow your business. Would love to help.
Outstanding. And then very last slide, everything that I do here at Cashflow and Cooke Mortgage, we offer conventional loans, FHA, VA, USDA, jumbo loans, investor cash flow loans. We can help you with purchases, refinances, your primary residence, second homes, investment properties. We do home equity lines of credit, fixed rate second mortgages. If you have not worked with us, we have our 8-day rush service, which really allows you to speed up the process and compete against cash offers. Our average clear to close is actually now 17 days, which is industry leading. We have our 100% pre-approval track record. If we give you a pre-approval, that loan will close. For agents on the call, we have a great partnership with HomeBot that you can actually get HomeBot for 50% off to stay in touch with your database. We do a lot of e-flyers and single property websites for your listings. And just like you're experiencing today, we teach all of our classes in person or online. And a really important point, every single client closing with us right now gets a free 1-year buy down. So what that means is, let's say they qualify for an interest rate of 6.5%. They would have an interest rate with us of 5.5% for the first year. And then they also receive our free refinance voucher that they can refinance with no closing costs at any point in the future. So one of the objections you're probably getting from your clients is, yeah, but interest rates are really high. I want to wait. Well, let me just share with you that Joe Massey can help you with a free reduction on your interest rate for the first year. And whenever interest rates go down in the future, you can call Joe back and refinance with absolutely zero closing costs. So this is something that we're using and we're seeing agents and buyers utilize a lot in order to get their buyers under contract and keep things moving. So if I can do anything to help you, please always feel free to give me a phone call. You can reach me at 303-809-7769. You can check out my website, loansbyjoemassey.com. Of course, follow us on Facebook, Instagram, LinkedIn, and even on TikTok. And scan the QR code for our free mortgage calculator, which can be co-branded to you, real estate agents. If you'd like this mortgage calculator with your picture and your contact information on there, send me an email and we will be happy to get that customized for you as well. All right, Jared, any final thoughts or anything else you want to add?
Guys, if you haven't seen, go to Joe's website, loansbyjoemassey.com, all the classes that he's recorded. There's lots of other investor classes on there. The Burr method, which I think we're doing that here in the next couple
tomorrow.
of days.
We're teaching that tomorrow.
Yeah. So, great ways to, get involved in this on the investing side of the business and representing more clients, because that's how you're going to increase your business also.
Outstanding. Guys, thank you for the positive comments in the chat box. If you have other
Absolutely.
questions, call, text, email, reach out to Jared. We would always be happy to help, and hope you guys all have a fantastic day.